The price-to-earnings ratio is a widely used financial metric for valuing businesses. It provides a quick snapshot of how much investors are willing to pay for every dollar of a company's earnings. In essence, it reflects the market's perception of a company's future earnings potential. Calculating the price-to-earnings ratio is straightforward. Divide the company's current market price per share by its earnings per share. For example, if a company's stock is trading at $50 per share and its earnings per share is $5, its price-to-earnings ratio would be 10. This means investors are paying 10 times the company's current earnings for each share. Understanding the components of the price-to-earnings ratio is crucial. The market price per share represents the price investors are currently willing to pay for a single share of the company's stock. Earnings per share, on the other hand, indicate the company's net income divided by the number of outstanding shares. In essence, the price-to-earnings ratio provides a measure of how much investors are willing to pay for a unit of a company's earnings. A higher price-to-earnings ratio generally indicates that investors are more optimistic about the company's future prospects and are willing to pay a premium for its earnings. Conversely, a lower price-to-earnings ratio may suggest lower investor confidence or that the company is undervalued. When comparing price-to-earnings ratios, it's essential to distinguish between public and private companies. Public companies, whose shares are traded on stock exchanges, tend to have higher price-to-earnings ratios than their private counterparts. This difference stems from several factors including liquidity and risk perception. Public companies benefit from higher liquidity, meaning their shares can be easily bought and sold on the open market. This ease of trading makes them more attractive to investors, driving up demand and consequently, their price-to-earnings ratios. Additionally, public companies are subject to stricter regulatory requirements and greater scrutiny from analysts and investors. This transparency reduces information asymmetry and lowers the perceived risk for investors, further contributing to higher valuations. Private companies, on the other hand, are not publicly traded and have lower liquidity. Their shares are not readily available on stock exchanges, making it more challenging for investors to buy or sell them. This limited liquidity often translates into a discount on their valuation, resulting in lower price-to-earnings ratios compared to public companies. Moreover, private companies typically have less stringent reporting requirements, which can increase information asymmetry and investor risk perception, further impacting their valuations. The extent of the discount in price-to-earnings ratios for private companies can vary, depending on factors such as the company's size, growth potential, and industry dynamics. Generally, a discount of 30% to 70% compared to comparable public companies is considered reasonable. For instance, if a comparable public company has a price-to-earnings ratio of 20, a private company in the same industry with similar growth prospects might have a price-to-earnings ratio in the range of 6 to 14. While the price-to-earnings ratio is a valuable tool for business valuations, it's crucial to recognize that it's not a one-size-fits-all metric. Adjustments are often necessary to account for unique circumstances and ensure accurate comparisons. One common adjustment is normalizing earnings to account for extraordinary or non-recurring items. Normalizing adjustments involve identifying and adjusting for income or expenses that are not representative of the company's typical operating performance. For example, if a company incurs a one-time legal expense or benefits from a substantial gain on the sale of an asset, these items would be adjusted to arrive at a more accurate picture of the company's sustainable earnings. Another important consideration is the impact of intangible assets on valuations. Intangible assets, such as brand recognition, intellectual property, or customer relationships, can significantly contribute to a company's value, but are not always fully reflected on the balance sheet. These assets can drive future earnings and provide a competitive advantage, justifying higher valuations. When intangible assets are substantial, it's essential to factor them into the valuation process. This can involve conducting additional analysis to estimate their value or using valuation multiples that are more appropriate for intangible-intensive industries. For instance, technology companies often have higher price-to-earnings ratios due to their significant investments in research and development, which create valuable intangible assets. The price-to-earnings ratio offers several advantages as a valuation tool. It's widely used and easy to understand, making it accessible to investors of all levels. Additionally, it allows for quick comparisons between companies within the same industry, providing insights into relative valuations. Moreover, the price-to-earnings ratio incorporates profitability, a crucial aspect of business performance, into the valuation process. However, the price-to-earnings ratio also has its limitations. It's sensitive to earnings manipulations, as companies can influence their reported earnings through accounting practices. Additionally, it doesn't account for debt levels, which can significantly impact a company's risk profile and valuation. Moreover, the price-to-earnings ratio is not suitable for companies with negative earnings or those in the early stages of development, as it relies on positive earnings to calculate the ratio. As an alternative to the price-to-earnings ratio, investors and analysts can consider the EBITDA method. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. The EBITDA method focuses on a company's operating cash flow, excluding non-cash expenses like depreciation and amortization. This approach can be particularly useful for comparing companies with different capital structures or those in capital-intensive industries. In conclusion, the price-to-earnings ratio is a valuable tool for business valuations, providing insights into market sentiment and earnings potential. However, it's essential to understand its limitations and consider adjustments for factors like normalizing earnings and intangible assets. By combining the price-to-earnings ratio with other valuation methods and conducting thorough due diligence, investors can make more informed investment decisions.